There is a market in the northeastern United States that most institutional investors and high-net-worth buyers have quietly started circling. They are not making announcements. They are not publishing press releases. They are simply moving capital. And the market they are moving it into is Pennsylvania. While the national conversation has been consumed by collapsing rents in Austin, Manhattan, and San Francisco, a fundamentally different story is developing in the Commonwealth. One that does not involve panic, oversupply, or desperate landlords throwing in free months of rent to fill vacant towers. This story is about structural undervaluation, a compressed yield environment that is beginning to expand, and entry points that have not existed in a full decade. Here is what most people completely overlook. The cities making headlines right now are not the cities where the next cycle of equity growth will originate. The cities generating the loudest noise are the ones already past their inflection point. The real opportunity almost never announces itself. Pennsylvania is not announcing itself. And that is precisely why it deserves your full attention right now. Before we go any further, there is something I want you to hold in the back of your mind throughout this entire breakdown. A specific mechanism, used by sophisticated investors in every previous down cycle, that transforms undervalued regional markets into long-term equity engines. I will walk you through it in detail later. But understand this: what you are about to learn in the next several minutes is not common knowledge. The buyers who are missing these opportunities are missing them not because the data is hidden, but because they are looking at the wrong markets entirely. Let us start with the foundation. Pennsylvania's housing market is not a monolith. That is the first mistake most outside investors make. They hear Pennsylvania and they think of a single economic profile. In reality, the Commonwealth contains at least 4 distinct market dynamics operating simultaneously. You have the Philadelphia Metro, which carries the gravitational pull of a major coastal adjacent city. You have the Pittsburgh Corridor, a post-industrial market that has quietly undergone one of the most credible economic reinventions of any mid-sized American city in the past 20 years. You have the suburban and exurban belt stretching through counties like Chester, Bucks, Montgomery, and Lancaster, where demographic migration patterns from New York and New Jersey have been quietly reshaping demand. And then you have the interior markets, places like Harrisburg, Allentown, Reading, and Scranton, which operate on entirely different yield and liquidity dynamics than the coastal metros most investors default to tracking. Stop here for a moment. Because this geographic diversity is not just interesting context. It is the structural reason why Pennsylvania has avoided the oversupply correction that has punished markets like Phoenix, Dallas, and Boise. When you have 4 distinct submarkets with different demand drivers, supply pipelines, and renter profiles, you do not get the synchronized overbuilding that creates those 12 and 14% rent declines. You get differentiation. And differentiation, for the disciplined investor, means opportunity. Now here is the data point that should reframe how you are thinking about this market. Pennsylvania's housing inventory remains significantly constrained relative to demand in key corridors. While cities like Austin added tens of thousands of new units in a compressed window, Pennsylvania's construction permitting environment, combined with its older housing stock and zoning complexity, has kept new supply from outpacing absorption. The result is a market where the rent-to-income ratios, though strained, have not broken the way they have in Sun Belt metros. Affordability pressure exists. But it has not tipped into the kind of demand destruction that empties buildings and forces landlords into capitulation mode. You might think constrained supply means higher prices and fewer entry opportunities. But the reality is more nuanced than that, and it is where the opportunity actually lives. The pain points that everyday renters and buyers are experiencing right now, the inability to absorb rent increases, the shift toward roommate arrangements, the retreat to family housing, these are not just hardship signals. For the analytical investor, they are leading indicators. They tell you where affordability pressure is creating motivated sellers. They tell you where landlords who over-leveraged during the previous cycle are quietly beginning to exit. And they tell you where below-market acquisitions are starting to surface, not as distressed fire sales, but as quiet, off-market transactions between exhausted operators and patient capital. I will show you exactly where in Pennsylvania those transactions are clustering, and which asset classes are generating the most compelling risk-adjusted returns in the current cycle. But first, you need to understand the demographic engine that is making this possible. Because here is something most people completely overlook about Pennsylvania's housing demand. It is not being driven by the same variables that drove Sun Belt growth. It is not remote work migration. It is not crypto wealth. It is not a speculative land rush. It is something far more durable and far more predictable. And durable, predictable demand is exactly what protects your equity when the broader cycle turns. That driver, and the full picture of where Pennsylvania stands relative to historical correction patterns, is where we are going next. Because once you understand what is actually moving this market, the opportunities that buyers are missing will become impossible to ignore. Pennsylvania's population story is not what most investors expect to find when they pull the numbers. And that gap between expectation and reality is where mispriced assets live. The dominant narrative around northeastern states has been one of outmigration. People leaving for the Sun Belt, chasing lower taxes, warmer weather, and the promise of cheaper living. That narrative is real in parts of the Commonwealth. But it is incomplete in the parts that matter most for asset allocation right now. Here is the pattern that the data actually shows. While Pennsylvania has experienced modest overall population fluctuation at the state level, specific corridors within the Commonwealth have been absorbing inbound migration from two of the most expensive housing markets in the country, New York City and New Jersey. Families and individuals who cannot justify the cost of remaining in Metro New York, but who are not willing or able to relocate to the Sun Belt, are moving west and south into Pennsylvania. Bucks County, Northampton County, Monroe County, the outer Philadelphia suburbs. These areas are not experiencing population decline. They are experiencing quiet, steady demographic infill from a migration corridor that does not generate national headlines but absolutely shows up in school enrollment data, retail absorption, and rental occupancy rates. Stop and consider what that means for yield sustainability. When demand is driven by proximity arbitrage, meaning people moving to your market because it is significantly cheaper than the market next door, that demand has structural staying power. It does not evaporate when a tech company announces layoffs 3 time zones away. It does not reverse when venture capital funding dries up. It persists as long as the cost differential between New York and eastern Pennsylvania remains what it is. And right now, that differential is not narrowing. It is widening. This is what I was hinting at earlier when I said Pennsylvania's demand driver is durable and predictable. Proximity arbitrage from a gateway city is one of the most reliable demand engines a regional market can have. And it is one that most Sun Belt investors never had access to, because the Sun Belt was absorbing national migration, not regional overflow. National migration is volatile. Regional overflow, driven by a permanent affordability gap between adjacent markets, is not. Now let us talk about where the specific opportunities are hiding, because the geographic nuance here is critical. Here is something most people completely overlook. In Pennsylvania's interior markets, the price-to-rent ratios are currently sitting at levels that have historically preceded sustained appreciation cycles. Markets like Allentown, Reading, and Harrisburg have median home prices that, when set against current rental rates, produce gross yield figures that coastal investors would find almost implausible. The reason these yields exist is simple. These markets have been systematically underweight by institutional capital, which has historically chased volume and liquidity over yield. Institutions want to deploy large amounts of capital quickly. Interior Pennsylvania does not accommodate that. Individual investors and smaller operators, however, can move efficiently in these markets. And right now, they have very little institutional competition. That asymmetry, low institutional presence combined with strong yield fundamentals, is exactly the setup that preceded value appreciation in markets like Pittsburgh's Lawrenceville neighborhood a decade ago, or Lancaster's downtown corridor in the cycle before that. The mechanism is consistent across cycles. Institutional capital avoids a market because of scale constraints. Smaller, more agile investors enter and stabilize occupancy. The market's income profile improves. Institutional capital eventually notices and begins to enter. Asset values compress upward as the yield gets bid down. The investors who entered early capture the equity gain. I will walk you through how to position ahead of that institutional entry point in just a few minutes. But first, there is a risk factor in this market that you need to understand clearly, because ignoring it has cost investors in similar regional markets real money. The risk is not oversupply. Pennsylvania's construction pipeline does not present the same threat that unwound Phoenix or Austin. The risk is liquidity. Interior Pennsylvania markets, and even parts of the suburban belt, carry longer average days on market than coastal metros. If your investment thesis requires the ability to exit quickly, these markets will punish you. Assets can take 6 to 12 months to transact at full value, and if you are carrying debt at current rate levels, that timeline has real carrying cost implications. You might think this liquidity constraint makes Pennsylvania a lower quality opportunity. But the reality is that it is precisely this constraint that has kept institutional capital on the sidelines and preserved the yield premium that makes the market compelling in the first place. The friction is the feature, not the bug. It is what has kept the market from being arbitraged to zero. The investors who have historically performed best in markets like this are not the ones looking for a quick exit. They are the ones with patient capital, low leverage ratios, and a clear asset protection strategy that accounts for the full holding period. Which brings us to the specific acquisition framework that top-performing regional investors are using in the current cycle. Because the entry point matters. The asset class matters. And the financing structure matters more in a high-rate environment than most buyers currently appreciate. The details of that framework, and the specific Pennsylvania submarkets where it is producing the most compelling risk-adjusted outcomes right now, are exactly what we are getting into next. Let us talk about the acquisition framework. Because strategy without execution is just analysis, and the buyers who are missing Pennsylvania's opportunities right now are not missing them due to lack of information. They are missing them due to a failure of structured decision-making in an environment that rewards precision over speed. The first principle of the framework is asset class selection. And this is where most outside investors make their initial error. When investors hear about an undervalued regional market, the default instinct is to target single-family residential. It is familiar. It is tangible. It photographs well. But in Pennsylvania's current cycle, the single-family segment, particularly in the suburban corridors absorbing New York migration, has already begun to reprice. The proximity arbitrage demand we discussed earlier has been flowing into that segment for long enough that entry valuations in Bucks County, Chester County, and parts of the Lehigh Valley have moved. The yield compression has started. You are no longer buying ahead of the curve in those specific asset classes in those specific corridors. You are buying into a move that is already underway. Here is something most people completely overlook. The segment where the curve has not yet moved is small multifamily. 2 to 4 unit residential properties, and in certain markets, 5 to 12 unit portfolios, are currently trading at valuations that have not caught up with the rental income those assets are generating. The reason is structural. Small multifamily does not benefit from the same buyer demand pool as single-family. Owner-occupant buyers, who drive price competition in the single-family segment, are largely absent from the small multifamily market. That absence reduces competitive pressure on valuations. And reduced competitive pressure means the yield premium persists longer. In markets like Allentown, Bethlehem, Reading, and Scranton, small multifamily assets with stabilized occupancy are currently available at cap rates that would be considered exceptional in any major metro. The assets are not glamorous. They do not have rooftop pools or concierge services. But they generate income, and in a high-rate environment, income is what protects your position while you wait for the broader market to reprice. Stop and consider the risk-adjusted logic here. An asset generating strong current income in a market with constrained new supply and durable demand has a fundamentally different risk profile than a vacant luxury unit in a Phoenix tower carrying a high-rate construction loan. The Pennsylvania small multifamily investor is collecting rent while waiting for appreciation. The over-leveraged Sun Belt developer is burning cash while waiting for occupancy. These are not equivalent positions. And yet the national conversation treats them as if the entire investment landscape operates on the same dynamics. This is what I was referencing earlier when I said the framework matters more in a high-rate environment than most buyers currently appreciate. When your cost of capital is elevated, current yield is not just attractive. It is your margin of safety. It is what allows you to hold through periods of market uncertainty without being forced into a distressed exit. The investors who got destroyed in previous correction cycles were not destroyed because they bought in the wrong market. They were destroyed because they bought with leverage structures that did not tolerate holding periods longer than their original underwriting assumed. Now let us address the financing dimension directly, because this is where the opportunity becomes actionable. Pennsylvania's market contains a meaningful inventory of properties held by long-term owners who acquired assets during prior low-rate environments. Many of these owners are at or approaching a natural exit point. Retirement, estate planning, portfolio simplification. They are not distressed. They are not defaulting. But they are motivated to transact, and in a high-rate environment where conventional financing creates affordability barriers for buyers, seller financing arrangements have become increasingly viable. Here is the mechanism. A long-term Pennsylvania property owner carrying little or no mortgage on an asset has the structural flexibility to offer purchase money financing at a rate below current conventional levels. The seller generates a yield on their equity that exceeds what they would receive from most fixed income alternatives. The buyer accesses capital at a cost that improves their cash-on-cash return relative to conventional financing. Both parties benefit from a transaction that the conventional lending market would make prohibitively expensive. You might think seller financing is an obscure or uncommon structure. But the reality is that in regional markets with older ownership demographics and low institutional presence, it is far more prevalent than most outside investors realize. The investors currently circling Pennsylvania know this. It is part of why they are circling. The due diligence framework for these transactions requires a specific discipline. You are underwriting not just the asset but the seller's title history, any existing liens, local rental ordinances, and the municipality's code enforcement posture. Pennsylvania municipalities vary significantly in their regulatory environment for rental properties. Some are landlord neutral. Others carry inspection requirements, rental licensing structures, and habitability standards that create compliance costs which must be factored into your yield calculation before you commit capital. I will walk you through the specific due diligence checklist that separates informed Pennsylvania acquisitions from costly mistakes in just a moment. But first, there is one more market dynamic that every buyer in this space needs to understand because it is quietly reshaping the opportunity set in real time. The distressed inventory pipeline. It is not yet visible in the headline data. It is not generating news coverage. But it is building beneath the surface of Pennsylvania's market in a way that mirrors what preceded the most significant regional buying opportunities in the previous cycle. And the buyers who recognize it early will have access to acquisitions that simply will not be available 12 months from now. That pipeline, where it is concentrating, why it is forming, and how to position ahead of it, is exactly where we are going in the final section. The distressed inventory pipeline in Pennsylvania is not arriving the way most investors expect distress to arrive. It is not a wave of foreclosure auctions. It is not a cascade of bank-owned properties flooding the MLS. It is something quieter, more gradual, and in many ways more actionable for the prepared buyer. Here is what is actually happening beneath the surface of the market right now. A significant segment of Pennsylvania's small and mid-sized landlord base acquired properties during the previous low-rate cycle using adjustable or short-term fixed financing. Those rate structures are now resetting or maturing into a refinancing environment that is fundamentally incompatible with the cash flow profiles these operators underwrote. The math no longer works. A property that generated positive cash flow at a 3% debt cost becomes a liability at 7%. And when a property becomes a liability, the operator faces a decision: inject additional capital to sustain the position, restructure the debt, or exit. Many of these operators are choosing to exit. Stop and consider what that means for buyers with dry powder and a clear acquisition thesis. This is not the catastrophic distress of the previous major correction cycle, where over-leveraged developers abandoned half-finished towers and banks absorbed losses across entire portfolios. This is granular, property-level distress, distributed across hundreds of individual operators making quiet decisions to reduce exposure. It does not generate headlines. It generates off-market opportunities. And off-market opportunities in a supply-constrained regional market are precisely where the most durable equity gains originate. Here is something most people completely overlook. The most valuable acquisitions in any correction cycle are never the ones that make the news. The foreclosure auction that gets covered in the local press is already fully priced for distress by the time the coverage runs. The real opportunity is the property that trades 3 months before it would have reached that stage, between a motivated seller who wants a clean exit and a buyer who did the relationship work necessary to be in the room when the decision was made. That relationship work is not complicated, but it is deliberate. It means engaging with local property management companies who know which operators are under cash flow pressure. It means building relationships with estate attorneys and accountants who advise the aging landlord demographic that owns a disproportionate share of Pennsylvania's small multifamily inventory. It means being present in the local market in a way that positions you as the path of least resistance when an operator is ready to move. This is what I was pointing toward earlier in this breakdown when I referenced the mechanism that sophisticated investors use to transform undervalued regional markets into long-term equity engines. The mechanism is not a financial instrument. It is not a novel acquisition structure. It is information asymmetry, maintained through consistent local market presence, that allows you to transact before the broader buyer pool even knows an asset is available. Now let us bring this down to the specific due diligence framework that protects your capital once you have identified an acquisition target. Pennsylvania's regulatory environment for rental properties is highly municipal in character. Unlike states with uniform statewide landlord-tenant frameworks, Pennsylvania delegates significant regulatory authority to individual municipalities. This creates a landscape where two properties in adjacent zip codes can carry materially different compliance obligations, inspection requirements, and eviction procedure timelines. Before committing capital to any Pennsylvania rental acquisition, your due diligence process must include a direct engagement with the relevant municipal code enforcement office to understand current and pending rental licensing requirements, a review of the property's complete inspection and violation history, and a clear accounting of any open permits that could create title or financing complications at closing. You might think this level of municipal-level diligence is excessive for a regional market acquisition. But the reality is that code compliance exposure has quietly eroded returns on otherwise sound Pennsylvania acquisitions more than any other single factor. It is the detail that separates investors who consistently perform in this market from those who chalk up their Pennsylvania experience as a disappointing outlier. The second layer of protection is your financing structure. In the current rate environment, preserving optionality in your debt structure is not a preference. It is a necessity. Fixed-rate seller financing, assumable existing mortgages where available, and conservative loan-to-value ratios that give you meaningful equity cushion from day one are the structures that allow you to hold through the liquidity constraints we discussed earlier without being forced into a value-destructive exit. Here is the convergence point that ties everything in this breakdown together. Pennsylvania's housing market is presenting a specific and time-sensitive alignment of conditions that has historically preceded sustained regional appreciation cycles. Constrained supply. Durable proximity-driven demand. A motivated seller cohort facing rate reset pressure. Suppressed institutional competition in the small multifamily segment. And entry valuations that have not yet caught up with the income these assets are generating. None of these conditions will persist indefinitely. The rate environment will eventually shift. Institutional capital will eventually find its way into markets it currently considers too small to underwrite efficiently. The motivated sellers who are quietly exiting right now will have exited, and the buyers who waited for the opportunity to become obvious, to make the headlines, to be validated by the national conversation, will be paying the prices that the early movers established. The pattern is not new. It has played out in every regional market that eventually attracted mainstream attention, from Pittsburgh's neighborhood renaissance to Lancaster's downtown transformation to the suburban Philadelphia corridors that now command premiums unimaginable a decade ago. The sequence is always the same. Quiet entry by informed capital. Gradual stabilization of fundamentals. Mainstream recognition. Valuation compression as the yield gets bid down. The question is never whether the cycle will complete. The question is always which stage you enter at. Right now, in Pennsylvania's housing market, the quiet entry window is open. The buyers who are missing these opportunities are missing them because they are watching the wrong markets, reading the wrong headlines, and waiting for a signal that will only arrive after the best entry points have already closed. The market does not wait for consensus. And the most expensive decision any investor makes is the decision to wait until the opportunity feels obvious. Pennsylvania feels anything but obvious right now. Which is exactly the point.